Well, ladies and gentlemen, today is officially the Super Bowl of Finance, aka the FOMC meeting with the Fed. Does happen today at 2:30 p.m. We are hours away from knowing exactly what is going to happen around rate cuts, rate hikes, or keeping things the same. Now, we already know the predictions, 0.25 to 0.5. We've been hearing some crazy predictions as well. We're going to talk about it. We're going to be addressing it. And we're also going to talk about why Jerome Powell, aka the chairman of the Fed, might be ready to pump these markets. Welcome to the channel, everyone. My name is Nick. For those that are new to the channel, hopefully by the end of this video, you do become a subscriber. If we take a quick look at the live time, 2:30 p.m. EST, is when the FOMC meeting does begin. I think everyone should be checking this out because it's not just about crypto. It's not just about pumping prices. It's not about the stock market or anything like that. This also gives us some insights on what's going to be happening around basically everything. Finance as a whole, our economy as a whole, and it definitely does have some effects outside of the US as well. So definitely stay tuned to this. Outside of this, we have over here, it's officially Fed Day. Markets are heading into the most divided Fed meeting since 2008. And yes, this is the largest FOMC meeting pretty much since 2008. It's pretty crazy. The majority of investors think that the Fed should cut interest rates by 50 basis points today, but here's why history says you don't want a 50 BPS rate cut. And this is what I did say the other day as well. Here we have currently 65% of investors believe that the Fed should cut interest rates by 50 basis points. Over the last 40 years, there have only been 2 times that the Fed started with a 50 basis point cut. Both times it did not end well for the S&P 500. And you can check that out on this chart here. This is the CME Fed Watch tool, conditional meeting probabilities. And this is giving us insights on, what percentage of investors believe that we should see a 50 BPS. If we come down here, here is a chart summarizing all interest rate cut cycles since 1995. The last 2 times the Fed started with a 50 basis point rate cut, the S&P 500 lower 15% and 22% lower over the next 12 months. All rate cut cycles started with a 25 BPS cut have positive 12-month returns. And yes, this is exactly why, I don't believe that we are going to start with a 0.50% first cut, because it doesn't make any sense to me. It really doesn't. So we probably get to 0.25%. We probably pump for about 12 months or so. Most risk on asset classes, like for example, crypto, will most likely top earlier. So about roughly quarter 1, quarter 2 of 2025 is what I'm really kind of looking at. Again, I could be wrong on that, but that's my overall time frame. But we also have down here that all rate cut cycles that begin with a 50 BPS rate cut came during a crisis, 2001 during the dot-com bubble and 2007 during the financial crisis. The Fed has sided with 25 basis point rate cuts at the start of every rate cycle, unless the economy was in a major crisis. Here are the S&P 500 returns of rate cut cycles over time, and of which did not start with a 50 BPS cut. History says that starting with a 25 BPS cut results in an average S&P 500 return of about 10% plus in 3 months. That's the average annual return of the S&P 500 in 3 months. And yes, if we actually look at this, that would be a significant return on the S&P 500, especially considering the fact that we are at all-time highs when it comes to stocks. Ultimately, history says that a 50 basis point rate cut is only needed if we are entering a recession. If we are not entering a recession, the Fed should cut by 25 basis points. Post-rate cut return differences are massive depending on if a recession hits, as shown below. Now, a lot of people have argued that we are already in a recession, that's basically it, right? We're in a recession. We're not entering a recession. We're not going into a recession. We're already in it technically. And I've agreed on that. I definitely have. I do think that the warning signs are already there, but they are still propping these markets up. It's election year. They're propping the markets up. We probably get the 0.25 basis point rate cut. And the reason why is because for the next roughly 12 months, Stocks do really good, markets do really good, they keep everything afloat, and then all of a sudden, boom, the biggest crash ever happens. We've talked about this. I think that makes sense. But we have down here, historically, the S&P 500 returns plus 15% within a year of the first rate cut if there is no recession. If there is a recession, the S&P 500 loses negative 15% in the first year on average. The Fed needs a soft landing to avoid a major market downturn, which many believe is possible. Today, the market is currently implying an S&P 500 move of about plus negative 100 points after the Fed decision on Wednesday. That's a 1.8% move, or 20% of the average annual return of the index in one day. We'll be trading this volatility directions with our premium members. Now, listen, at the end of the day, we are hearing some substantial urging of what Chair Powell should do. For an example, Democratic senators are now urging the Fed to cut rates by 75 BPS. Wild to me. If we really think about this, I mean, if we're cutting by 0.50 when we are entering a recession or a major crisis, what would we call cutting by 75 basis points? That's pretty substantial. Outside of this, we have Fed to cut rates by 0.5% from JP Morgan. Again, everyone is focused on what JP Morgan is saying, what Democratic senators are saying, or what Elizabeth Warren is calling for, which is also 0.75%, which this is kind of tied right back to this as well. But the big thing to focus on here is we probably get the 0.25%. I actually think that this is pretty much straightforward. I think that this is what we get. This is from Citibank. They're predicting 1.25 basis points cut in 2024. First, we get 25 BPS today. We get 50 BPS at the November meeting, and then 50 BPS in December as well. So again, that would be 1.25 basis points. Now they also say, or 50 basis points today in November and 25 basis points in December. Again, the argument for a 50 basis points cut is strong. Again, I would like to see the first one, 0.25 today, 0.50 in November, 0.50 in December. I think that would be fair. But again, we have to watch, wait, and see. We can't get too ahead of ourselves. The best way to prepare for this accordingly is to have stablecoins on the sidelines. I've always mentioned this. We will talk about some charts here in a second. We'll also talk about something that I think everyone should be paying attention to outside of what the Fed does. We also have over here, Fed is coming down the mountain after 11 rate hikes in 16 months. The Fed held steady for a year. Inflation peaked at 9% in 2022 and now sits under 3%. The new worry is jobs. Over 1 million jobs have been revised lower over the last 24 months. New job openings have slowed from 210,000 per month to 142,000. Again, this is why a lot of people say we're already technically in the recession. But we also have the unemployment rate is up from 3.5% to 4.2% since July of 2023. Rate cut incoming as the labor market cools. Powell at 2 p.m. Buckle up. And this is very interesting to see what happens next. Again, I do think that something will eventually break. When we think about what the Fed wants to do here, they are in a sticky situation. It's definitely not, if I was the Fed, I wouldn't want to be in this position, but this is exactly what we were preparing for. Now, what exactly do I mean by that? Well, let's go back to March of 2023. I said retail is being told lies right now, that their bank accounts are safe, depositors will be covered, and all is sunny in the world of finance. And this was during the time where bank collapses were happening. And in fact, even more bank collapses did happen after. The truth is that the Fed is at a very scary point in time where either the decision to pause or raise rates will ultimately lead to systemic chaos. Now, the same goes here, right? No matter what they want to do here, pause, cut, definitely not raise, it will still lead to a recession being noticeable. Things really aren't getting all that better. I mean, yes, technically, things are looking good. But this is exactly how every single crisis looked before the big show came to a close. I always say, when you go and look outside and your neighbors are buying brand new cars and everyone's living the good life, typically it leads to everything being taken away. Right now, we're not really seeing the good life. People are not buying heavily, but this is why we focus on where we're headed. Right now, they're creating the illusion that everything's all good, that we're bouncing back, that, inflation is going down and, everything's all good. But on the back end of things, we know that that is just not the case. Jobs are still cooling off. Things are still looking a little rocky. Inflation is still brewing. Credit card debt is skyrocketing. So I do believe that we probably get 12 months of up only, or at least, some decent amount of time. And then the show comes to a close. Now, as we do focus on that, this is the Bitcoin chart. This is also the dollar chart. So in the Discord, we have been following this chart for a while. Right now, we are filling a fair value gap on Bitcoin. It is questionable on if we are going to come down to, 58.6K to completely fill this or not. But from here, we should have a nice move to the upside, unless we lose this low at around 58.6K. From that point on, I would be looking at substantial lows being ran around 55.3K to about 56.4K. But outside of that, the decision today is definitely going to cause volatility. So prepare yourselves for that. Buckle up and prepare for volatility. But outside of Bitcoin, right, we've been focused on the dollar. Now, I have addressed this in the Discord multiple times. This thing has been playing along our path perfectly. We have this nice fair value gap up here. It's actually a bearish fair value gap. Bitcoin did breach down to the liquidity lows going all the way back to December of 2023. Then we hit this fair value gap. Boom, we rejected already off of it multiple times now. So this is a very weak spot for the dollar. It's actually a lot of resistance up there. And from this point on, I'm still expecting significant lows to be ran. Somewhere around roughly 99.56. This is those liquidity lows from July of 2023. If we lose this, that's it. Risk on asset classes like crypto and stocks will go absolutely parabolic. Why? Because we are losing the last major low since going all the way back to 2022, guys. So this is going to cause a ton of mainstream media focus. We're going to see retail really hyping it up. We're going to see it everywhere, and everyone's going to be questioning where we head to next. And ultimately, the big focus is running the lows from March of 2020, aka COVID, right around roughly 94.56 to 96.15. That's what I'm really kind of looking at next when it comes to the dollar. If we lose this level that we are ranging on right now, today will be the deciding factor on what the dollar does next. But beyond that, right, the number one thing to focus on is the M2 money supply. Everyone is focused on the interest rate cuts this week, but M2 money supply is now expanding at the same time. Cheap capital is coming fast. And if we look at this, yes, for the first time in a very, very long time, the M2 money supply is flipping positive. This is very, very good. In fact, if we go back to 2020 for an example on this chart, you can see what this means for risk on assets during 2020 into 2021, one of the largest bull runs in crypto history. We are watching this closely because this will lead to prices ripping, liquidity improving, liquidity flowing into markets. Again, cheap capital coming back. This is a very good sign for risk on assets. And even over here, we have global M2 money supply has reached 95 trillion. Bitcoin and global M2 money supply correlation. For every 10% increase in global M2 money supply, Bitcoin pumps 90%. Since July, M2 money supply is up 5%, but Bitcoin is down 10%, aka it is a lagging factor. A reversal is in the cards. September has historically been Bitcoin's worst performing month, which means we can expect a few more months or a few more weeks of chop before the sentiment shift. Fed meeting on Wednesday will provide insight on this. And yes, this meeting is very crucial to focus on, but at the same time, we are starting to see all the warning signs there to have risk on assets go absolutely parabolic, melt up during a recession technically, all for them to melt down after. Again, we always talk about this when it comes to the dot-com bubble, whenever we talk about previous recessions. Here we have, right? This is the big focus. This is the S&P 500. If we go back in time and look at those crucial moments in history, we could technically see that, during those big recessions, those big crises, stocks, everything goes crazy for a little bit of time. And it fakes a lot of people out. That's why, like I said, you will see everyone doing very good, buying up a whole bunch of stuff that they don't need during a time where we're headed towards one of the worst moments in history, aka one of the biggest crashes, one of the biggest crises, a recession. It always happens. So that's why I do believe that we melt up first, only for us to melt down. That's why I told you guys that, focus on money market funds. $6 trillion in there. That does not happen during a recession. The recession is technically already here, but it's not as noticeable as most people can perceive. So when we think about that, they're going to prop markets up for a little bit of time, make everyone, think that, oh, look at everything's all good, only for everything to collapse after. So focus on this, prepare accordingly, and make sure that you are taking profits when the profits hit. So with that being said, I hope you guys enjoyed this video. If you guys did, definitely leave a like, subscribe, turn notifications on because more free content. You guys are more than welcome to follow me on Twitter and join the free Discord down in the description below. And with that being said, guys, it's been Nick. Thanks for watching. Peace out.